Good afternoon, grade 12 learners. My name is Mr. Simbi, and welcome to today's accounting lesson. I know you have been looking forward to today's class, and it is a pleasure to have you in my class today. Everyone is worried about tomorrow, but I know that you guys are prepared. You have put in the hours, and because of the hours that you've put in, I do trust that tomorrow is going to be a good day. But I'm just here to remind you a few things that we have done during the course of the term. You remember we have been having these lessons, and there are lessons on this very same page that if you don't remember some of the things we have covered, please do search on this very same page. You find your statement of comprehensive income, you find your correct net profit calculation, statement of financial position. The cash flow statement is also on this very same page. Okay, so without further ado, let's get down to today's business. All right, what are my objectives in today's lesson? In today's lesson, I intend to talk on the structure of paper one, because remember tomorrow we are writing paper one. So I will talk on the structure of paper one today. I'll also talk on the statement of comprehensive income. I'll also do in today's class the correct net profit calculation. I'll also do the statement of financial position, and when time permits, I'll touch a bit on the cash flow statement. So there are aspects that I will not be able to touch because of time, such as your corporate governance, your analysis and interpretation of financial statements. I would want to encourage you that you do that in your own time. But in this 1.5 hours, please, let's focus on this. There is a worksheet which I believe you have in your possession, which was sent to your school. So if you do not have this worksheet, please speak to your teacher. Your teacher should be able to help you to get this worksheet that will enable you to be able to work perfectly. All right, so let's go. When we talk of the structure of our paper one, you have to understand that there are certain topics which will be covered in paper one. In this case, we have several options in which our questions can be tested. But if you look at the structure of paper one, you will see the topics that we will be dealing with is the calculation of correct net profit after tax and the statement of financial position. So this is a fusion. This is a combination of the calculation of correct net profit together with the statement of financial position, your balance sheet. So the examiner can bring these two together. That is the calculation of correct net profit together with the balance sheet. And in the statement of financial position, it can be the entire thing, or it can be a section, your assets, or it can be your equity and liabilities section. So all the options must be covered. And then the next one is your cash flow statement and financial indicators. Remember, you need to be able to calculate financial indicators. You must know your formula sheet. You must know the formulas to your financial indicators so that you're able to calculate. Your analysis needs to be considered as well. So analysis and interpretation of financial statements will also be part of the paper. And then definitely you'll get your auditing and corporate governance. And tomorrow's paper will be out of 150 marks. So this is what we would expect. In terms of the adjustments will vary. They will be all over the place. But normally, this is what we would expect in our paper one. All right. So I gave you the first option. Here's option number 2. You will see that my number 2, 3, and 4 remain constant. But what can change is the options in question 1. The first one, we had the correct net profit together with the statement of financial position. That was option number 1. Option number 2 is when we have the statement of comprehensive income, that is your income statement, together with the statement of financial position. So it is possible that you can have your statement of comprehensive income together with the statement of financial position. All those possibilities are available. So please, when you prepare, make sure that you prepare adequately. So your cash flow statement, you can see this one remains constant. your analysis and interpretation of financial statements also remain constant together with auditing and corporate governance. Let's go and look at the next option. Okay, so that is what I was talking about, that question 1 will be structured in different ways. And it is to encourage you that you do sufficient practice on financial statements in order for you to be able to answer the paper. Here is option 3 now, okay? Here is our option 3. In our option 3, remember, number 2, number 3, number 4 remain constant. What can change again is that question 1. So you find here you have a statement of financial position and notes. So the first option, remember, correct net profit and statement of financial position. Second option, full statement of comprehensive income and the statement of financial position, which can be the entire thing or it can be sections of it. Third option is the statement of financial position together with its notes. Remember, when you talk of notes, we would focus mainly on note number 3 up to note number 9. All these notes can be tested. And then the last one is the statement of comprehensive income together with its notes. Okay, so we have looked at these options, which are about 4 options. Okay, so the structure of question 2 and 3 is predictable. In other words, here we have kept it constant. What was changing is that very first part alone. All right, so this was option number 4. Okay, I know what you're thinking. Now that we know the structure of the paper, let's get down to calculations. So we're going to do that. Make sure as I write, you also write. So I brought in different kinds of adjustments so that you can be exposed to different ways in which the examiner can test certain adjustments. What we want to do is just to get exposure, to get exposed to different ways in which the examiner can ask some adjustments, so that if anything comes, we are well prepared. And need I remind you, I do have confidence in you, and I know that tomorrow you are going to make us proud. Okay, so let's go to the first activity. Activity number 1. Our activity number 1 is extracted from the NSC June for the year 2023. Okay, so as I said earlier on, if your teacher has not given you the worksheet, then probably you can download this particular paper. But I would advise you that let's work it out together before you can refer to the memo, because there are certain sections that I'll touch, but then there are other sections which I may not touch depending on the time and the areas that we want to cover in today's class. Okay, let's begin. So here it says Starlight Limited. The information relates to the financial year ended 20th February. The company trades in electrical items. Okay, and then calculate the value of closing stock of light bulbs on 20th February using the weighted average method. Okay, so what we want to do is you have to understand that in paper 2 we have inventory valuation methods, your FIFO, your weighted average, and your specific identification. All right, but these methods can also be tested in paper 1, depending on what the examiner wants to test us. In this paper, there was an inventory valuation question which came into paper 1. So I just wanted to say, it is very important that you prepare yourself, that you need to know certain topics which spread between paper 1 and paper 2. And these topics are your inventory valuation together with your tangible assets. Calculation of depreciation can be found in both paper 1 and in paper 2, as well as your inventory valuation. So you cannot say, I will not prepare on this, I'll only prepare for paper 2, lest you find that aspect in your paper 1. So you should be able to prepare your inventory valuation as well as your tangible assets, that is the calculation of depreciation. For these two topics can be in both paper 1 and paper 2. They can be in both depending on the examiner's intentions. Can I go? All right. So here we are going to calculate the value of closing stock. And here is the information that we're given. So we are then told, so you need to have your pen ready and you need to have somewhere to write because we're going to be doing a lot of writing. It says, number one, a physical stock count on 28 February revealed that 2,774,800 stock on hand. However, this figure excludes the closing stock figure for light bulbs. Note that the weighted average method is used to value light bulbs. All right. So we would want to know, because we are told that we have this stock on hand. However, this figure excludes the value of closing stock, the value of the units that have not been recorded. And we're told that we use the weighted average method. So what we want to do now is to calculate the value of those units. Okay, so what do? We start now. We say, if we're using the weighted average method, remember we have to divide. It has to be our rands over our units, rands over units. And then we could have said opening stock plus purchases. But you already know that if I do say that, it will give me the units available for sale. So I might as well just take those ones. So I'll come here and I'll say the units available for sale, which is your 3,478,000. And then I say plus, do I have any carriage? Yes, there is your carriage, 27.5. I understand that this 3,478,000, this is in rands, but its equivalent in units is 55,000. So I'll come here, then I'll divide this by 55,000 units. And then I'll get the average price per unit in this case, which is going to be, okay, so you know I need your calculators ready now. How much is that going to be? Say it again, 71 Rand 30. Then you now say, this is your average price per unit. You multiply it by your closing stock, which is your 1,700. And then that will give you your 121,210. So this therefore becomes the value of stock which was not recorded. In other words, if I want to know my stock now, I'll be coming here to say 2,774,800. Then I would say plus 121,210. Okay, when we're still here, let me talk of the options that the examiner can test you on. Number one, the examiner can test you on stock that has been stolen. When we're on inventory, remember, stock that is stolen, and then the insurance company covers a part of it. Or stock that is damaged. It can be stock that is damaged, and then the insurance company will cover a certain percentage. Or they can talk about stock that has been donated and has not been recorded. So whenever the examiner brings in the aspect of physical stock count of stock, what the examiner wants to drive to eventually is the calculation of trading stock surplus or trading stock deficit, depending on the question that is on hand. In this case, we are preparing the statement of comprehensive income. So definitely we have to consider our trading stock surplus or trading stock deficit. But the first part, we have to calculate the stock that was not recorded. And in this instance, they brought us the weighted average. But remember, the examiner has so many options to explore. They can talk about stock stolen, stock damaged, or stock donated, or an invoice that was incorrectly recorded. What is important is that you expose yourself to several ways of doing this very same adjustment. Okay, I'm going to move on now to the next one. So this is the very one that we're doing. So we now know the value of our stock, okay, which is our 121,210. Remember, we have just calculated this figure. So the next thing that we want to now do is to go and record in our statements. So the first one is in the statement of comprehensive income, your income statement. And the next one is going to be under your current assets. Okay, I would prefer that let's start under the current assets so that you really understand how this all works out. Okay, so this is how it works. If you're to record what is here in your statement of financial position under your current assets, you're going to come under what we call trading stock. So I'm coming here to say this is my trading stock. Okay, this is my trading stock. And then I open my bracket. And then I am now saying on my trading stock, I had 2,774,800. So here it is, 2,774,800. And then we discovered that there was some stock that was not recorded. So we'd come here, then would say plus how much? 121, 210. And then we are then told that this figure excludes, so this is the stock that is now on hand, okay? And then we have to understand that the trading stock that we're given is 2,969,800, okay? 2,969,800, that was the figure that we're given in the business books. Okay, so if we come here again, we're going to now see that our stock on hand now is going to be, I'm going to close this now, and then our stock on hand is going to be 2,896,010. Okay, so we took the one that was on hand here, and then we added on the stock that was not yet recorded, and then we end up with 2,896,010. So this becomes the final amount in our inventory amount, trading stock. Let's come now to our operating expenses. So we understand that we have stock, which is 2,896,010. This is the stock that is now on hand. Yet in our books, we have stock which is 2,969,800. So that simply means what we have according to the business records, is more than what we have on hand. On hand, we have 2,896,010. But in the business books, it must be 2,969,800. That simply means we have a trading stock deficit. So we'll come here, then we say trading stock deficit. Okay, so to get our trading stock deficit, we're now saying the 2,969,800, and then we then subtract the one that is on hand, which is your 2,896,010. Someone would have come here and said minus 2,774,800, and then you say minus again 121 210. It would still come to the very same thing. So here you simply broken those two apart, but here you're subtracting it as a full amount, and then eventually you get a trading stock deficit, which is how much? 73,790. So the idea here was to be able to calculate the value of stock that was not recorded and be able to see the difference between the stock on hand and the stock in the business records. Once the stock in your business records is more, that means you have a trading stock deficit. But if your stock on hand is more than the one on the business records, therefore we have a trading stock surplus, which goes to other income. Are we together? But remember, this adjustment can be tested in several ways. As I said earlier on, goods that were destroyed by fire, goods destroyed by water, goods stolen, goods donated. an invoice that was not recorded. All right. All of these are options that the examiner can use eventually to arrive at demanding you to calculate trading stock surplus or deficit. Okay. I'm going to move on to the next one then. Here's the next one. In the next one, we are required, it says, calculate the total depreciation for the year. Total depreciation for the year. Okay, I think I skipped one. Here it is. Here is the first one. The first one says, calculate the profit or loss on disposal of vehicle. So here we're now bringing in the aspect of asset disposal. Okay, and we need to calculate either the profit or the loss on the disposal of the vehicle. What are we given? We are told an old vehicle was sold for, very important, sold for 91.5 on 30 November. The amount received was recorded, but no further entries were made. Okay, so once they say no further entries were made, that simply means we need to record either the profit or the loss. Let's hear. Details of the vehicle sold, and here are the details. Depreciation of the remaining vehicles, we're given that one. So we want to calculate whether we made a profit or a loss on the disposal of the vehicle. Okay, so we have the carrying value, which is 104. What is carrying value? Carrying value is cost minus accumulated depreciation. It gives you carrying value. When we talk about carrying value, therefore, we're simply talking about the worth of an asset. How much is the asset worth? How much is its value presently? The carrying value. When we look at the cost, we subtract accumulated depreciation. So we were not given the cost. We were not given the accumulated depreciation, but we're given the carrying value of 104,000. And we did not dispose this asset on the very first day of the year, but we disposed it. We're told that we disposed it on the 30th of November. That means this asset worked for us in this year. Once we have used it, it will lose value, depreciation. So it means I must calculate the depreciation for this year for me to get its exact carrying value on the day of disposal now. You still following me? So it means I need to know which method of depreciation I'm going to use. And here I'm told it is 20% per annum on the diminishing, not diminishing, diminishing. So it means I'm going to take here my 104, which is my carrying value. Remember, diminishing balance method, we calculate depreciation on carrying value. 104 multiply by 20 over 100, multiply by how many months? So we calculate the months, therefore. We're calculating from the 1st of March. Can I see your fingers? All right? Don't take chances tomorrow. Use your fingers. So we're going to count from March, April, May, June, July, August, September, October, November, because it's 30 November. So we count November as well. Multiply by 9 over 12. You still following me? Okay, let's go on. How much is that going to give us? Can I see your calculators, please? 15,600. Are we good? So it means in this year, this asset has lost 15,600 to depreciation. Okay. Its carrying value was 104. Then we subtract depreciation, 15.6. Its carrying value on the date of disposal, its carrying value on the date of disposal, therefore becomes, calculators please, how much? 88,400. That is the carrying value on the date of disposal. Now, we then say, if the carrying value on the date of disposal is 88.4, we want to know whether we made a profit or a loss. A profit or a loss. Okay. So we sold the vehicle for 91.5. Yet its carrying value was 88.4. It will give us either profit or loss. If you use this method that I'm giving you here to say we sold it for, your calculator should be able to tell you whether you made a profit or a loss. So you're simply saying 91.5 minus 88.4. And on your calculator, you see that it's giving you a positive figure. And the positive figure is 3,100. That means here you have made a profit. If it's positive with this method, sold for 91.5, yet the carrying value is 88 to give you either a profit or a loss. A positive figure is a profit. A negative figure is a loss. So if you stick to this method, that is. But here's the simple understanding. Our vehicle is worth 88.4. That is its worth. It's worth 88.4. However, we've sold it for 91.5. So we've sold it at a price above its worth. We made a profit. We sold it at a price above its worth. Definitely, we made a profit. So we have calculated the profit to be 3,100. Okay, thank you. I know you understand what I'm doing now. Okay, let's move on to the next question. As the guys are saying, they want us to move to the next question. Let's move on to the next question then. The next question then says, calculate the total depreciation for the year. Calculate the total depreciation for the year. All right, so we understand. So here's the vehicles, and we know that we had depreciation. Remember, when you calculate depreciation, you have to calculate for your what? For your son. Remember that. The S stands for your sold, the O stands for your old, and the N stands for your new. So whenever we are calculating depreciation, we have to think sold, old, and new. Are you still with me? Okay. So here, we are aware that we have depreciation for the sold. How much is depreciation for the sold? It is 15,600. Okay, we calculated it earlier on. And we have depreciation for the old. That is the remaining. That is the old remaining, which is 145,200. The old remaining, which will give you now the total of 160,800. That gives you your total depreciation. Okay, this is for what? This is for the vehicles. Remember, this is for your vehicles. But we don't only have vehicles. We also have another asset called equipment. Let's go and see on equipment. We're told equipment is depreciated at 15% per annum on cost. New equipment is bought on the 31st of July in the year 2022. So we have new equipment here. We don't know where is the new equipment. They never told us. How are we to know if this is new equipment? Where do we find that new equipment? You must be able to see that if your equipment in 2022 is 774 and the equipment in 2023 is 822, provided that no equipment was sold, this difference will give you the new equipment. Provided that no equipment was sold, therefore it will give you the new equipment added. So we should be able to get the new equipment added. How do we get that? It is your 822,000. Then I subtract the 774, which I had at the beginning. Therefore, my new equipment which was purchased is say it again. Okay, it is how much? 48,000. Okay, it is 48,000. the new equipment that was purchased becomes your 48,000. Okay, so here it's 48,000. That is the new equipment that was purchased. Okay, so let's now come to the calculation of depreciation. Let's now come to the calculation of depreciation. We will now say on the calculation of depreciation, remember we calculate depreciation for what? For the sold, the old, and the new. Okay, so we have new equipment here, but we also have our old equipment. Let's go and see. Let's start with the old one. The old equipment, remember we're calculating depreciation at what? Using the cost price method. So, which is at 15% per annum. So I'm going to say now, it is my 774,000. Then I say multiply that by 15 over 100 times 12 over 12. So this is for the entire year now, because this is my old, the one that was there right from the beginning. So if I do that, how much am I going to get? I need depreciation. I'm saying it is 774 times 15 over 100 times 12 over 12. Okay, so I get 116,100. This is my depreciation for my old. And then I'm going to come now and calculate for the new. For the new one, remember, it is your 48,000 here. 48,000 multiplied by 15 over 100. And then new equipment was bought on the 31st of July. So I'm not going to count from March. I'm going to count from the month after July. And the month after July is August. So I'm going to count August, September, October, November, December, January. And we know the financial year is ending in February. So that is 7 months because it's ending in February. Multiply by 7 over 12. How much is that going to give us? 4,200. So here are my two depreciation amounts for the old as well as for the new. Now, I can come here and now record my amounts. I know that my depreciation on equipment, it is my 116,100 plus the 4,200. That gives me a total now, which is going to be 120,300. But if I'm to get my total depreciation in the statement of comprehensive income, I'm coming here to say depreciation. I'm opening bracket. Remember, depreciation for the vehicles was 160,800. Then I add depreciation for the equipment, which is 120,300. I close this bracket and I end up with 281,100. That becomes the final figure then. So the idea here was to be able to split between your old and the new one which we've acquired, which you only see that with a new one because you have that amount there that is increased. Provided there was no disposal, that would be the easiest way to pick up the new equipment that was acquired. Okay, I'm going to move on to the next one. The next one says, received 9,000 from the insolvent estate of a debtor Billy Kroon. His estate paid 80 cents in the rand out of his outstanding balance. The money received was recorded. The balance of this must be written off. Okay, so we understand that we have a debtor who is Mr. Billy Kroon. Mr. Billy Kroon owes us a particular amount of money, which is the 100% of the debt. However, his estate has paid 80 cents, which is 80%, 80 cents. All right, so his estate has paid 80 cents, or if you can call it 80%, it's still one and the same thing, to the rand of his outstanding balance, the money received was recorded. So the money received is 9,000. So this is the 9,000. That means he has not paid us the 20% or the 20 cents in the rand, which we need to calculate. So to calculate that one, which is the balance that must be written off, we will now say what we want is 20. What we have is 80. Multiply by 9,000. Punch that in your calculator. How much are you going to get? And then you get your 2,000. Say it again. 2,250. 2,250. That becomes the bad debt. So I'm going to come here and I'm going to say bad debts. I'm going to open my bracket. So I'm going to take the amount that was provided already, which is my 16.2, and then I'm going to say plus how much? The 2,250. Then I close my bracket, which is now 18,450. 18,450. Let's go on to the next one. So the next one is how this affects the statement of financial position. Okay, so I'm coming here to my trade and other receivables, whereby I would have my trade debtors, trade and other receivables. So I'll just come here on my debtors, which I'll be given. So I'm just going to come and say minus 2,250. I have to subtract. What is this? This is bad debts. When you have bad debts being written off, they'll come and increase here. They'll also decrease your trade and other receivables. They'll decrease your trade and other receivables. Okay? But this adjustment is totally different when they bring an adjustment which says a debtor that was previously written off. A debtor that was previously written off would therefore be bad debts recovered. Make sure you expose yourself to these different kinds of adjustment. Here we're writing off a debtor from the business books, bad debt. When the account was previously written off and the account is now recovered, that then becomes bad debts recovered. There's a distinction between these two. So make sure you don't confuse these two if at all you meet with such an adjustment. You know we're talking about tomorrow, okay? All right, so just make sure you are well equipped with such adjustments. Let's go on to the next one. The next one then says provision for bad debts. All right, and it says provision for bad debts must be increased to. Okay, so this here becomes our key now. Increased to. Already we know that we have an increase here. Okay, so let's start. In the statement of comprehensive income, once we see the word increase, we know once we have an increase is an expense, yet a decrease is income. Just to simplify that, how do you know whether you have an increase or a decrease? You would be able to compare. So you would compare your last year and your current year. Your last year provision, that is your 21,020, and this year's provision is 25,720. You can see there is an increase. It has increased from that to that. By how much? Calculators, guys. Calculators. By how much is it increased by? Thank you. 4,700. So this has increased by 4,700. And we understand the moment it's an increase, what is it? An expense. So I'm going to come under my operating expenses and I'm going to say provision for bad debts adjustment. And I'm going to say now it was my 25,720 minus my 21,020, and I close my bracket. Then here my 4,700. That is how I would record it in my statement of comprehensive income. But when I come now to the statement of financial position, let's see. If I come to the statement of financial position, I'm coming to my current assets, trade and other receivables. It could be that you are given note number 5 to prepare. Let's assume you're given note number 5. Remember, inventory will be your note number 4. We have done that one. So let's assume you're given note number 5. You'd come, and remember, these are our debtors. And what is this one? This one was what? Bad debts. You still remember, okay? And then you then come here and subtract the provision. In this case, you are not taking either the increase or the decrease, but you take the two amount. The two amount is what comes here into the balance sheet. So you come in and subtract the 25,720. That is what you subtract from there. And then you get your final amount there. But because we're still busy with this question, we're not going to close this bracket as yet. I'm going to push a little bit further. Can I go? Okay, let's go then. It says director's fees. Okay, so with director's fees adjustment, you have to know there's several ways in which the examiner can ask this. They can bring an increase in percentage, a decrease in percentage. All of these are options that the examiner can exploit in calculating director's fees. But this one was a different way. Let's see how this one was tested. It says the company has 2 directors. So here's director number 1 and here's director number 2. So 2 directors that we have here appointed in 2019. That means when we began this financial year, they were already there. That's why they're trying to say it. A 3rd director was appointed on the 1st of October. So we have another 3rd guy here coming. And then all the directors earn the same monthly fee. Okay? Directors' fees paid during the financial year have been recorded. Directors' fees paid during the year have been recorded. But one director, let's assume it's this guy here, one director has already been paid for March and April. We understand that our financial year ends when? In February. March and April means we're adding 2 more months to the 12. That means here we end up with what? 14 months here. And here it's what? 12 months. You still with me? All right, the first 2. And then this new director appointed on the 1st of October. So we're counting October, November, December, January, February. You still with me? How many months are those? That gives you 5. So you now say 14 plus 12 plus 5. Calculators. How much you got? 31. So it means whatever we have here, that is what was paid for 31 months. 2,015,000 is what was paid for 31 months. Can I go? All right. How much is the director's fees per month then? 65,000. Thank you. So what is our problem? This guy here has been paid for March and April. That is 2 months. So this guy has been paid for 2 months in advance. That's 130,000. Okay. So what do we have now? A prepaid expense. You good? Okay, let's go on. So we come here, we say director's fees, which is my 2,015,000 minus 130,500, the prepaid expense. And then we know once we have a prepaid expense, it goes to trade and other receivables. So I'm going to come and say plus 130,500. Okay, so you can see what I'm doing here. I'm trying to cover the statement of comprehensive income. At the same time, I'm trying to cover the statement of financial position because we don't know what demands the examiner can bring. You should be able to take an adjustment into the statement of comprehensive income as well as the statement of financial position. That is a must. You must be able to do that. An adjustment, statement of comprehensive income, same adjustment, statement of financial position. That's what I've been doing from the start of today's class. Are we good? Okay. All right. Let's go on then. Let's go on. Here's the next adjustment. Rent adjustment. Okay. Let's come back to this director's fees adjustment. What other ways can the examiner bring this? It can be various ways. An increase as a percentage or a decrease as a percentage. The director's fees, it can be one of the directors has retired. I've seen whereby one of the directors is going on a holiday, then they take an amount in advance. So make sure you expose yourself to several ways of doing these directors' fees adjustment. Not just sticking to the one where we calculate the months, but you can also use several other ways of doing these adjustments. Okay, let's come here now. Rent income includes, so this is the rent income adjustment. I know most of you are looking forward to the one that increases by a percentage, but in this case, they did not bring that one, okay? This one actually has an increase by 1,170. Let's see. So we have rent, which includes rent for March. Already we know we have a problem. Why? Because our financial year ends in February, 28 February. So once we see March, already we know. What is that? Income received in advance. We have 1 month which we need to solve here. How do we do that? We now say our rent income was increased on the 1st of January. Okay, so if I take 89,700 and I divide this by 13, is that correct? Certainly not. Why? Because there is an increase. So I need to say the increase of 1,170, for how many months was that for? That was for 3 months. Is that 3 months? Okay, let's count. Increase from the 1st of January, February. Then the year ended. But we also received for March. So we have 3 months here. Okay, tomorrow, please use your fingers. Okay, and then how much is that going to give you? 3,510. What is that? That is the increase for the 3 months. That means if I take my 89,700, I take out this increase of 3,510. I'm going to remain with rent for the 13 months without increase. Give me the figure now. How much is that going to be? 86,190. So this is rent for the 13 months, but without increase. So I can divide this now by 13. And then that's going to give me 6,630. Rent per month without increase. But we know it increased in January. That means in March, that rent had an increase. So I'm going to come and say plus 1,170. How much is that going to give me? 7,800. What is 7.8? Income received in advance. I know in the income statement, I'm going to subtract it. In the statement of financial position, that is my balance sheet, I'm going to take it to trade and other payables. Let's see if that can be done. Let's come here. So I'm going to say here, what is that? Rent income. So I'm saying here, rent income. I'm opening my bracket. It's 89,700. You still following me? Then I'm going to say minus how much? 7,800. And then I'm going to remain with 81,900. I'm going to come to my trade and other payables, whereby I'm going to record now. Remember, this is already trade and other payables. So that means this is my note number 9 already. So I'm going to now say income received in advance. Okay. And then I open my bracket. That is my 7,800. Are we good? Okay. I have so much that I want to do with you. Can I move on? Let's go then. Let's go. All right. So I'm going to go on to the next one. Loan adjustment. Ooh. There is several loan adjustments that you have to know. There's the T account. There's the one by months. You have to be able to know your loan adjustments. Okay? Very important. How the loan adjustments affect the income statement. How the loan adjustment affects the statement of financial position. How the loan adjustment affects the cash flow statement. This is of great importance because your loan will affect all the 3 financial statements. You must be able to do it in all the 3. Are we good? All right. Let's see what this adjustment is now saying. Loan from Pearl Bank. Interest on the loan is capitalized. Has not been recorded. Fixed monthly repayments, including interest, have been paid correctly, recorded in the for the financial year. Interest on the loan amounts to 60% of the monthly repayments. What is that now? Okay, let's see. Okay, so we're going to record that one. Profit before interest. Okay, so to get this loan here, we know that our loan was 690. Loan at the beginning was how much? It was 690,000. But loan at the end is now how much? 524.4. Okay, so how much of the loan has been paid? 165.6. This is what has been paid. We see it by the decrease in the loan. Okay, the decrease in the loan means repayment of loan. Okay, can I go on? So we are told interest on the loan amounts to 60% of the monthly repayments. That simply means if I come here and I want to get my interest expense, I would say 165.6, which is the repayment. Then I get my 60%. Then I get my 60% here. That is going to give me 99,300, which is in brackets interest expense. It has to be in brackets. Okay, let's go on to the last part now. So the last part is on your net profit before tax, and then you have income tax. All right, so we are told income tax was calculated to be, so this is income tax for the year. This was not a problem. Net profit before tax, income tax, net profit after tax. That is not a problem. Okay, so just remember tomorrow, if anything like this would come, here it has to be what? 100%, and then here you're given a particular percentage. Then if it's 30, then it's 70. If it's 28, then it's 72. It all depends with what you are given. Okay, and then we now need to see if we can take any amount to either trade in other receivables or trade in other payables. Let's ascertain that first. So income tax provisional payments, we've made provisional payments of 875, yet the tax for the year was supposed to be 858, 140. So that means our provisional payments are more than the income tax assessment for the year. Therefore, it means we've paid more. The difference would therefore come to your receivables. How do you get the difference? It's 875 minus your 858, 140. And then the difference would be your 16,860, which you'd bring here and say plus 16,860. Okay, I'm going to start activity 2. Which is over here. But we're going to take a quick 2-minute break, only 2 minutes. So we're going to take a quick 2-minute break, and then I'm going to see you after the short break.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinganga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you're gifted in, whether it's sports, it's academic, ucula, whatever that gift is, Strive for excellence.
Welcome back, dear learners. Before the ad break, we did the statement of comprehensive income together with the statement of financial position. Okay, remember in one class, we cannot cover every single adjustment, but we did our best. Now, what we want to do is to go to the free state prelim for the year 2022 and want to do the calculation of correct net profit, which is in there. Okay, so here it is. It says, use the information which relates to Global Trading Limited and the financial year ended on 30 June 2022. The business uses the perpetual or the continuous inventory system. Calculate the correct net profit after tax. You ready? Let's go. Okay, so here's the information that was given. Here's more information. There it is now. Okay, and here we go. Number one now. We're going to begin with the first one. We're told the net profit before tax was 1,089,239 was determined before taking into account the following information. So the provision for bad debts was not yet considered. Okay, so we understand here that if we have a provision for bad debts, in the statement of comprehensive income, we record either an increase or a decrease. You remember what I said? An increase is a what? An expense. And a decrease is what? Income. Okay, so we would say last year versus this year. How much was last year? 10.6. And how much is this year? It is 7,800. So if I'm to get the difference, it gives me 2,800. That is the difference. Okay, so what do you see now? Here we're dealing with a decrease. Once it is a decrease, we're looking at income. So let's come here. When we come here, we're now going to say our provision for bad debts adjustment. Okay, so here is the provision. I'm going to write just shorthand. Okay, let me write in full. Provision for bad debts adjustment. So we are now saying it is your 10,600 minus your 7,800. And it's going to give you 2,800. Now, this is income that was not recorded. This is income that was not recorded. That means when I come here, I'm adding this income. So you see, I've put a plus there. I'm adding that. Okay, let's quickly see if I would record this in my trade and other receivables. The first thing that I would have, obviously, is my debtors control. All right, which is this one here, which is my 742,488. You still with me? And then I would come here and I would say my provision for bad debts. And my provision for bad debts is how much? 7,800. And therefore it would give me 734 actually, 734,688. And what do we call this? Net trade debtors. This is my net trade debtors. Can I go on? Okay, let's move on to the next one quickly now. Let's move on to the next one. So this is how I'll do my provision for bad debts in the calculation of correct net profit. Let's go to number two. Number two, an invoice was issued. Okay, so an invoice was issued on 30 June for this amount. A 10% trading discount was allowed. Goods were sold with a markup of 60%. No entry has been made of this transaction. Okay, so goods were sold. So, and we're told the invoice had this amount on the invoice. If we are to record here, because we are in the calculation of correct net profit, we would want to know the profit that was made on these goods, the profit that was made on this invoice. Okay, so if I were to say 8,712 multiply by 60 over 100, will I be correct? No, because we are dealing with an invoice that was already after trade discount. So I would want to know what was the original invoice amount so that I can calculate the cost of sales and come back again to calculate the profit. Okay, I just wanted to show you why this calculation would not work. So I would therefore come here and I would say the amount on the invoice is 8,712. You need to understand that this is after 10%, so this is 90% of that invoice. But now what I want is the original amount before this 10% trading discount. So I want 100, but I have 90 times 8,712. That is going to give me 9680. Okay, so this was the original amount on this invoice. And then if this was the original amount on this invoice before the trade discount, I can calculate cost of sales then. I know every time cost is 100. In this case, markup is 60. Therefore, selling price becomes 160. I want 100. And what I have is the selling price, the amount that was on the invoice before the trade discount, 160. And then that will give me 6,050. So I would come here then and I would say, if I have an invoice, that invoice was for 8,712. But the original cost of those goods, is 6,050. Therefore, the actual profit that I'm making is 2,662. What did I call this? The profit. So I'm going to add it to my incorrect net profit because there is profit on an invoice that was not recorded. So I have to come and record it over here. Let's go on. Then the next one then says, the auditor discovered that the trading stock deficit of 5.6 was trading stock surplus. Okay, so this adjustment, I think you've seen it in your creditors recon, whereby an invoice is recorded maybe as a debit note. In other words, the sign becomes wrong when an amount that was supposed to be added is subtracted. When an amount that was supposed to be subtracted is added. This is what they're talking about. When they discovered that trading stock deficit, it was supposed to be subtracted. However, it was recorded as trading stock surplus. It was added to the net profit. In other words, when you come to the net profit, you should now say this 5.6, it was discovered that the trading stock deficit was a trading stock surplus. So we subtracted an amount that we're supposed to add. In this case, we're going to add it how many times? Twice. So we're going to say 5.6 plus 5.6 to give you how much now? 11,200. And what is this? A surplus. A surplus is income. So we come and we add it to our net profit. This is when a deficit is recorded as a deficit, yet is supposed to be a surplus. It was supposed to be a surplus, yet it was recorded as a deficit. Can I move on? Let's go. The next one then says, consumable goods on hand at the end of the financial year amounted to 5,400. Okay, so this one now is something that you need to take care of, because there's a difference between consumable goods on hand and consumable goods used. Okay, there is a difference there. Consumable goods used, that is the expense for the year. Consumable goods on hand, that is the goods that have not been used in this year. Therefore, this expense is not for this year. So now they're telling us that consumable goods on hand at the end of the financial year amount to 5.4. When we have such an adjustment, it simply means our expenses need to be reduced. Our expenses need to be reduced. When you are reducing expenses, you are increasing your profit. So in other words, you're coming here and you're saying consumable goods. You're coming here to say consumable goods, and you're taking that 5.4. You're adding it to your profit. You're simply saying the consumable goods used are not 5,400 more. In other words, my expense is not 5,400 more. I still have some of these consumable goods that have not been used, which therefore means I must be able to increase my profit because my expenses must be decreased. When you have consumable goods on hand, that will be added to your net profit. Okay. The next one then. Directors' fees paid for the year amounted to 648. Okay, so this one was a different directors' fees adjustment as well. Let's see. The company has 5 directors who received the same fee. Okay, so we have 5. Just quickly, 1, 2, 3, 4, and here's the 5th one. Okay, who received the same fee. One of the directors asked the company to only pay out his fees for the last 6 months in July. So this guy received for 12, this for 12, this for 12, this for 12. But this one is received for 6 months. All right. So you're going to say this plus that, plus that, plus that, plus that. How much are you going to get? You're going to get how much? Okay, thank you. 54 months. So that simply means when we come here, we're now going to say on our director's fees, the amount that we have here, which is my 648,000. This is director's fees for 54 months. That means how much are we giving each director per month? How much is that going to be? 12,000. Is that true? All right. So we're giving each director 12,000 per month. And we have a director who has asked to only be given his director's fees for the last 6 months in July. July is the next financial year. July is the next financial year. So he's saying, please pay me next year. Okay. But regardless of the fact that we will pay him next year, remember, he is part of the company's expenses for this year. So the director's fees for this year must still be recorded for this guy. So we pay them 12,000 per month per director, and we have one director who said, my fees for the 6 months, please pay me in the following year. That means it's going to be 72,000. So we have 72,000, which is an expense that has not yet been recorded. That means it must decrease my profit. So I'm coming here to say minus 72,000. That is director's fees that were not yet recorded. And then I come to my trade and other payables. I now know I have an accrued expense, because when am I going to pay it? July, which is the next financial year. So I'm going to come here and say plus how much? 72,000. That is the director's fees which will pay in the next financial year. Trade and other payables. Accrued expense. Can I go on? Let's go. The next one then reads, BE Builders was paid 120,000 for the construction of a storeroom, 90,000 in repairs to the building, 30,000. The entire amount was debited to the land and buildings in error. Okay, remember this adjustment. You have seen this adjustment 1,000 times. It simply means that 30,000 must be recorded under an expense called what? Called repairs. So we have an expense that was not yet recorded because the entire amount was debited to the land and buildings, and that was an error. So I'm going to come here and I'm going to say now we have an expense that we must record, and that expense is 30,000. Therefore, it's a minus 30,000. Okay, that one was easy. Why? Because I had the answer put in already for you. Okay, let's go on to the next one. Let's see the next one. Let's see the next one. Let's see the next one. And it says, rent for July 2022, 3,300 was received in advance. Okay, so they don't want us to calculate here. They just want to see how do we treat this rent that was received in advance. So rent income, we have received rent income in advance. That means our profit has been overstated. Once our profit is overstated, then that is incorrect because July is in the next financial year. So we have to come here and take out this rent which was received in advance, minus 3,300, like that. But we understand that once we receive income in advance, it must go to trade and other payables. So I'm going to come here to my trade and other payables, and I'm going to say plus 3,300. Okay, I'm going to move on to the next one. And the next one reads, advertising includes a 6-month contract for 7,200. Okay, so the 7.2 is for 6 months. Okay, 7.2 for 6 months. How much is it per month? 1,200. Okay, let's go. With the local newspaper, this amount was paid for the period 1 May to 31 October. Okay, so we know our financial year ends when? On 30 June. So if it's ending on 30 June 2022, yet it's been paid to 31 October 2022. So this is our problem here. We're going to count July, August, September, October. How many months is that? 4. So we have 4 months that was paid in advance. 1.2 times 4. How much is that going to give us? 4,800. So I'm going to come here and I'm now going to say on my advertising, I have prepaid an expense. I paid an expense for the next year. That means my expenses were more, overstated. Once expenses are overstated, my profit becomes understated. I have to reverse that now. So that means I have to come. Even though it's an expense, I have to come and add it now to my incorrect net profit. Why? Because it's an expense that was recorded for the wrong period. It's supposed to be for next year. But in this year, we'd recorded it, hence it decreased my profit. So to correct it, I add it back. Next one, please. And it's the last one, and it reads, income tax amounts to 333,564 for the year. Already you have an idea what is going to happen here. You're just going to come here and it's 333,564, and then you get your net profit after tax, which is your 677,236. And we should be able to record that one as well under our current liabilities. All right. Our income tax for the year was provisional payments. The provisional payments were 300,000. The provisional payments here, the provisional payments were 300,000. Okay, so the provisional payments were 300,000. So we have made less provisional payments than the income tax. So hence you see I already have my current liabilities. So I'll come here and say SARS income tax, and then I'll open my bracket, which is my 333,564 minus my 300,000, and that will give me my 33,564. Are we good? All right. So I know you are thinking, Mr. Simbi, are we going to get time to do the cash flow statement? Yes, we are going to get time to do the cash flow statement. We're going to do it in the next 2 minutes. So please make sure you get some water to drink. In the next 2 minutes, we're going to continue with the cash flow statement. Activity number 3, NSE June 2023. See you in 2 minutes. Welcome back, guys. Before the break, we did the correct net profit calculation. You saw what we did? When an expense is overstated, that amount must be added back to the profit. All right? So keep that in mind. Make sure you practice so that if a statement of comprehensive income comes, you're covered. Statement of financial position comes, you're covered. Calculation of correct net profit, if it comes, you're still covered. Depreciation calculations, if they come, you're covered. Invoices not recorded, you are covered. Stock damage, stock stolen, all these adjustments, insurance, we did several adjustments. Please visit them. With me here, I have this activity, and we're going to prepare the retained income note. Okay, so we're quickly going to go now. Let's start. Format. You need to know your format. You need to know your format. You know, in accounting, format has to be in the fingertips. You have to know your format. Like in this case, we start with balance at the beginning. After that, what comes next? After that, I must get my net profit. What is this? Net profit after tax. Okay, net profit after tax. It was given 1,526,000. After the net profit after tax, what is the next thing that comes? Repurchase of shares. Let's go do that one. Okay, so here we come. So here I'm going to write my repurchase of shares. Now, what I'm going to do now, because this is a question that also affects the cash flow statement. You should be able to prepare the cash flow statement, but also you must be able to analyze it. You must be able to analyze it. That if you're given 2 years cash flow statements, 2022, 2023, you should be able to see the change in the years. But apart from that, you should be able to use your 10 minutes reading time to say, what else am I required to do? Like in this case, in the cash flow itself, they would require you to record the proceeds from shares issued. So that means I would need to open my ordinary share capital note, note 7. But where am I? I'm in note 8 here. But I'm going to do note 7 nonetheless. When the demand for it comes, I should be sorted already. Okay, so can we do that? Let's do that. We are told here in 2022 is 12 million. Please write this with me, okay? 12,312,500. Can I go? At the end, 13,959,500. We still good? Okay. So this is at the end here. Let's come here now. At the beginning, there was 1,250,000 shares. 1,250,000. These are ordinary shares at the beginning. Then 180,000 shares were repurchased. That means brackets everywhere before I even do anything. I come here, then I say 180,000 shares repurchased, and they do not qualify for dividends. You hear this? Very important. We're going to come back to this. The moment they tell you that they do not qualify for dividends, you should take note of that. An EFT was issued. So if an EFT is already made, that means I can divide this 1,989,000 by 180,000. You still with me? How much am I going to get? 11 rand. Say it again. 11 rand what? 5 cents. That means I now know I have my triangle here. Remember the triangle? I have my triangle. So at the top is the cash flow statement. What goes to the cash flow statement? 11 rand, 5 cents. What has been paid? EFT. You still with me? So remember that when I get to it. 11 rand, 5 cents. And then I'll come again. Then there were shares issued at 11 rand 40. We don't know the shares that were issued at 11 rand 40. But we're told we have 1,370,000 shares at the end. We good? So I should be able to get that one. Okay, reverse calculation. How do you do these reverse calculations? This is what you do. You simply say your 1,370,000, then you say plus. So the one that is a minus, you add that. 180,000 plus 180,000, then you come and say minus 1,250,000, and then it will give you 300,000. So I'll come here now and I'll say here we've issued 300,000 shares at 11 rand 40. Quickly now, 300,000 multiply by 11 rand 40. How much are you gonna get? 3,400,000 and what? 3,420,000. Thank you. 3,420,000. Now we can get this one now. It depends on how you want to do it. If you want to do the reverse calculation, or if you want to calculate the average price, you can still calculate the average price in this case. All right. How do you calculate the average price? You would have taken the 12,312,500 and you divide it by your 1,250,000, and that would give you 9 rand 85. 9 rand 85 becomes the average price here. That is the average price that goes to note number 7 here. So repurchased at 9 rand 85. You multiply this by 9 rand 85 and it will give you 1,773,000. Okay, can you give me a thumbs up if I'm correct? Thank you. Thank you. So you get this 1,773,000. Okay, you could have got that reverse calculation again. It would still be the very same thing. Now, in the retained income, we want the repurchase of shares. We know in the retained income, we record the amount above. All right, so we're saying 11 rand 5 cents minus 9 rand 85 minus 9 rand 85. That is going to give you 1 rand what? 1 rand 20. 1 rand 20. Okay, so 1 rand 20 is the above. So I'll come here and I'll say repurchase of shares. How many shares were repurchased? 180,000. 180,000 multiplied by the amount above 120. 1 rand 20. I know my bracket is already put in here already. And that is 216,000. Okay, we good? Ah, thank you. Thank you. So I know when I get to the cash flow statement, they're going to ask me to talk about the repurchase of shares. They're going to ask me to talk about the what? The proceeds from the issue of shares. Okay, so the proceeds of issue of shares, I already have the amount. Repurchase of shares, I already have the amount to use. The 11 rand, 5 cents. Okay, let's continue with the retained income. So this is what we have done so far. And then now we're going to calculate our dividends, interim dividends. On our interim dividends, to get the interim dividends, we are told that interim dividends are given on the 31st of August. But the shares repurchased, remember, they say they do not qualify for dividends anymore. So it would be 1,250,000 minus the 180. How much do you get? Say it again. 1,070,000. 1,070,000 shares. Then I multiply that by 32 cents. That's going to give me 342,400. 342,400. And then we would then conclude it as we bring in our final dividends. Our final dividends are shareholders for dividends. That one is a piece of cake. It's just going to be your 575, 400. And then when you add these, it gives you those two there. And then that concludes your retained income note. Okay, just for 1 minute before I say goodbye, let's quickly come and look at this loan. If we're preparing the cash flow statement, then we'd say the change in loan. In a change in loan, you'd be saying from 2022 to 2023, you can see here that's a decrease in loan. So that is probably a repayment in loan. So you would be saying your 7.2 million minus your 6,348,000, and therefore your change in loan would be 852,000. If you're preparing the cash flow statement, this amount must be in brackets because a decrease in loan means a cash outflow. You have paid the loan. And then the last part before I say goodbye and wish you well, it is the amount, the proceeds from issue of shares. Okay, proceeds. Okay, let me see if I can bring it. The proceeds from issue of shares. It is your proceeds. Okay, not yet time to say goodbye. I'm still going to talk about proceeds from issue of shares. Proceeds from issue of shares. Okay, so you would still come back again and say how many shares were issued. Remember, there were 300,000. Okay, and then the amount was what? 11 rand 40. Okay, so multiply by 11 rand 40. These are the shares issued. Okay, and then it will give you your 3,420. But if it was the repurchase of shares, you would say how many shares were repurchased. If you still remember in that activity, we repurchased your 180,000 shares. We repurchased 180,000 shares, and from the triangle, the amount at the tip was 11 rand 5 cents, if you still remember. And then you simply get your amount over here. Dear learners, I have come to the end of today's class, as another class is about to start just now. But I want to wish you well for tomorrow. Remember to go over your corporate governance and auditing. Remember your audit reports, the different kinds of audit reports, how they affect the company as well. Remember as well to talk about your financial indicators. You need to be able to calculate your financial indicators. Remember, when you talk about financial indicators, you have to mention the name as well as the trend, the increase, the decrease, and the impact that it will have on the company. It has been lovely having you in my class. I hope to see you again tomorrow, same time. I'll be here as we prepare for paper 2. But from now on, all I can do is to wish you well, and I know you're going to make me proud. Tomorrow when you come to class, please tell me how paper 1 would have gone. All the best for tomorrow. You can do it once you believe it, and tomorrow is your day. Goodbye for now. See you tomorrow.